Hey traders, this is Mike with Vant Trading. I wanted to do a quick video for you guys to go over moving averages. Moving averages are typically the most misused indicator that I see new traders use when they start out trading. Moving averages can be a really valuable tool to a trader, but again, it's all in how you use the moving average. Now, first off, let's talk about what a moving average is. There's two kinds of moving averages. There's a simple moving average and then an exponential moving average. They both have their place on a chart, but they both do two different types of things. First off, a simple moving average is just a simple average of price data, doesn't really give any weight to the price, whether it happened, recently or it happened, a while, way back. An exponential moving average gives more weight to current price. So looking at those moving averages, they both have value. Typically, we use the simple moving average more for longer term trends and longer term price action that we're looking at. The exponential we typically use on a shorter time frame. Now, newer traders I see typically use moving averages the wrong way. They typically use them for some type of entry or exit system, which, it could be a crossover system like moving average crossovers. You got the death cross. What we've seen is typically those type of systems that are based where entries and exits are solely based upon, a crossover or a moving average. They typically are very unreliable and don't give a high percentage of really giving you some value there. Professional traders, what we like to do, we use moving averages a little bit differently. We like to use them to find value. We also like to use them to identify a trend or look for different areas of support and resistance. So let's take a look at the chart, see how we set up our moving averages, what we're using, and give you a couple examples on how we use them. First off, I find moving averages work really well when you're trying to identify a trend on, when you're looking at the markets overall, when you're looking at the indices. What I have pulled up here is the chart of the S&P 500 of the SPY. Okay, if you look here, basically from the end of last year, the SPY, the indices have pretty much been in what we like to call an active sequence. Okay. Now, the moving averages I have on here, first off, the top line that we have, this little dotted line here, is what is the 9 EMA. Okay, again, shorter time period. So I like to use the exponential moving average a little bit. It works a little bit easier. Then the line that's in purple or pink, however you want to look at it, is the 21 EMA. So the 9 and 21 really do kind of work hand in hand. And I got specific rules that we utilize when we talk about that, and I'll get to that in a minute. Now, what we have in the blue is the 50 simple moving average, and then the 200 simple moving average is in yellow. They're really good for more of the longer term trends. Now, if you look at the SPY here, I talked about that, it's in an active sequence. Now, some of the rules that we have when we're analyzing a type of market, we talk about being successful in trading is really being able to identify, what type of market are you in and what type of trades are going to work. A lot of times we rotate from being a day trader to also being more of a portfolio trader where we're, trading stocks, but we're letting them run a little bit. So it's kind of a portfolio trading for us really is not swing trading. It's not, I consider swing trading to be a little bit more longer term, but it's kind of a combination of doing some day trading, trading around value zones. And we use moving averages a lot to do that. So the basic set of rules when I'm analyzing a market. If you look here, when you have the moving averages, so you have the 9, 21, 50, and 200, when they're all stacked on top of each other, typically that's a pretty good market. That is, when they're stacked properly with the 9 on top and then the 21, 50, and then 200. Well, that right there signifies pretty good trend. They're pointing up, they're stacked appropriately. So we're in a bull market at that point. So when stock price is above the 9 and the 21, well, and they're stacked appropriately, that's what we call an active sequence, or a tradable portfolio sequence. So if you look here, when the market, back in November, right after the election, we got a nice little break here up above the 9 and the 21. And so another point that's really important is, when the moving averages squeeze together, like they're squeezed together in here, that's typically a point of indecision. Like it's, typically you're getting ready to break out or break down a particular way. So, when we see moving averages squeeze together, that's typically, a sideways move. We're getting ready for a possible, break one way or the other. So again, looking at this, as we're analyzing the SPY, the SPY has really, really since the end of last year, since the election, been in what we call an active sequence. And, it's been it's been easier to identify and trade because really there has been very few points where it is not, where price action has dipped below both the 9 and the 21. Now we use the 50, we call it the 50, sometimes the value zone. Sometimes 21's the value zone, sometimes the 50's the value zone. And if you look here in the SPY's price action, you would have done really well over the last year since the election, just trading from the bullish side. And if you look here, it's been very few times that we've really broken down and closed below the 21, and typically when we did close below the 21, we gravitated down to the 50. Okay. And really looking back at this market, and I've highlighted here, I've circled all the areas that we've come down and hit the 50. And really the 50 has proven to be the value zone. It's proven to be a really good buy point for the market. And, a lot of times we're maybe not, when a stock, like when the S&P came back down to the 50 here, then it got back up, right? And then, came back down to the 50 right here. This was back in May, right? Beginning of summer. Well, once it got back and started the active sequence again, boom, ready to trade. So typically, we're not, as professional traders, you're not looking to call bottom. So either point at any type of these value zones, we could have completely just turned the other way and went the other way down. So you don't want to be a hero. You're never going to be able to define a bottom, okay, where a true value zone. You only understand it when you look back. So when this market here, when the SPY got back above the 9, the 21, and it was pointing up, that's when the time to buy. And obviously you're not getting the bottom, but that's okay, right? To be a professional trader, to be in this consistently over a long period of time, you want to be able to stay in the game and trade when the odds in your favor. When the market's below the 9 and the 21 and it's flirting with the 50, you don't know which direction it's going to go. Now, proven this year, the 50's been a pretty good value zone, pretty good support zone, but that can change at any point. And when it does change, by you waiting for it to get back above the 9 and 21, that's going to save you for when that market does not come back and goes the other way. It's going to save you a lot of alpha. So again, the key is not to be right. The key is to lower your risk level and try to find areas of value and try to find the type of market that you're in to trade. So here, this has been a pretty good runner. Now, the other way we look at value is when price action starts to elevate away from the 9, okay? So looking here, and this is why we like the EMAs, right? The short-term price action. If you look at here, typically when a stock starts to pull away from the 9, then it's considered a little bit riskier. You got to be a little bit careful because typically that stock will come back in to the EMA. Okay, now there's two ways for the stock to get back into what we call the buy zone here in the value zone. One is for the stock to come back down and pull back into the EMA. And if you look right here back, right around the election, we kind of, got away from that moving average, gapped up here. And, we're ways pretty decent away from the 9. Well, the way this came back was it pulled back into the moving average. Now, another way once it starts getting out and away is for the market to go sideways, right? And the SPY's been pretty good at that as far as going sideways to kind of let the moving averages catch up. So now, if you go back and you look in here, and you're looking at this active sequence going up, it's been a pretty good, again, when the market kind of gets extended from the moving average, it typically will pull back or go sideways. And this market has been pretty good at doing that. So really, you got to go with what works until it doesn't work. And you can kind of see, analyzing the SPY, pretty good active sequence, and it's been a pretty good precursor to where value is. Now, looking at the QQQs, tech, same thing, again, you can kind of see in here tech a little bit differently, but once we got above the 9 and 21 got stacked in here pretty nicely. Look, we had a nice little active sequence that we're really still in till today. So you had some nice good action through the summer on tech. So basically and when you look at it on the reverse, here the 9 and 21 becomes a lid. So this wasn't the time to be holding tech, right? And it kind of keeps you out of all this chop and churn. Now, it doesn't mean you can't day trade, but from a portfolio perspective, it's going to give you a little bit of an understanding for where the market is. Now, let's look at it as far as how we used it in some stocks scenarios to really identify some positive trends that, because we always talk about successful traders, you want to let your profits run, cut your losses short. So obviously, how do you know it's so easy to say that, but how do you know to let your profits run? How do you decide, when you're going to get out and when you're not? Okay. Well, looking here, let's look at a couple stocks. And I will use Discovery as an example because this, I think, is a really good example. First off, you got to know what kind of, what your rules are and what you're trading, but looking at it from a top-down approach, right? Looking at Discovery. Well, last year, okay, Discovery had a nice just base that it was building and a nice tight base, not much range. We love stocks that break out from that base. First off, what do you notice about the moving averages in here when they get in that nice tight base? Well, they squeeze together, right? They squeeze together, and you can tell, look, it's nice and tight. You got the 200 really is a lid in here. And that's a stock that, okay, really, you don't want to be in that stock, okay? Because you want to be in stocks. There's always rotation. There's always stocks that are moving and in play at all times, right? The key for you as a trader is find out what's in play. And what this is telling me is this stock's not in play, right? Well, as we got towards November, all of a sudden we started to notice, okay, we started, closing above and we started kind of rounding a bottom up and it started to move and started to break out of this base. The reason we like this type of trade setup is because, again, it's like a coiled rubber. It's like a coiled spring, right? When you're tight, when that finally releases, typically it goes and you have some of the most powerful moves out of those bases. Well, if you look here, this active sequence in Discovery started about mid-November. Right here, the moving averages basically started stacking themselves, and we started moving out of this base here, and that's at about $25. So this is where an active sequence started. So you could have traded Discovery 25 up to about 29 bucks, right? And then it pulled back, right back into the 21, and maybe you take some profits as it comes back in, right? But then it gives you another opportunity to reload, and this stock from that point forward basically is on an ascent that just keeps on going all the way up to almost $80 a share. Okay, this is what we call an active sequence. And looking back at it from looking backwards, right? It's easy to backseat drive and look backwards, but we see this pattern play out over and over again, right? And so if you're using this, so let's look here, a couple things as we're looking at this chart. First off, if you notice the beginning of this year, you notice that it kind of got extended from the 9 EMA, right? It pretty much tight, got extended. When it gets extended, like it got extended in here, it pulled back, went sideways, caught up to the moving average. Here, same thing, started to get extended, hit $50 a share, pulled back, got, went sideways, and then it started its active sequence. So it gives you some opportunity. Look, when you're extended away, this is kind of how we trade this. When you're extended away from the moving average, we sell into strength. When it pulls back, then we buy back into weakness, right? And you do this throughout. It gets extended, you sell back into strength, you buy back into weakness. Same thing all the way up. So, the question is like, okay, Mike, that's great, but how's it work on the backside? How when to get out? Well, when this stock, gets below the 9 and closes below the 9, now it's a warning sign, right? It's below the 9, nice big gap in here, right? And so this is your first warning sign. Then the next day you get a nice break below the 21. Well, here, now that you're below the 9 and 21, this is your warning sign to get out in this area. So what this does is, though, think about this. You got involved in this stock at 25, traded it all the way up through to 80. Now, the trend reverses, and even if you're getting out at 65, right, you're never going to get the tops, you're never going to get into the bottoms, but if you can get the meat of the move, 80% of the move, then you really were a great trader, right? And so here, by getting out, by having a rule, getting out, breaking down through here, well, guess what happens? You get out at 65, this stock winds up going all the way back down to 27. So that's by having those rules really saves you on the downside, protecting your profits. Let me show you a couple other trades, stocks that we use this to trade. Home Depot, right? We traded Home Depot, and this nice little had, sideways action, not tight like Discovery's action was, right? But still in a channel, nice sideways action, but then finally bust through. And at the top of this range of this channel, it's in now a new active sequence. And, Home Depot, great trader, 278 all the way up. You almost get 100 points all the way up to trade Home Depot. And if you're looking at this, again, pretty easy trader all the way up, nice active sequence. Starts to violate it in here. So, maybe you sell, and then once it starts the active sequence again, you trade it up. And then again, look, it violates and starts to come back down. And this is when you knew to get out. Now, by the way, we are just so happen to be in Home Depot again. And the reason we're in Home Depot again is because we bought it on value here, and we're going to see if it can start and keep this new active sequence going. So that's how we're trading it. A couple other stocks of note, and you should be able to recognize these stocks. And right here again, wedging up into an important level, ACI, it's finally breaking through this level. It's everything's pointing up, nice active sequence, boom. You get acceleration up, nice trade. And now again, you sell into strength, right? Because you're so far away, you now are, the odds are basically against you because you're so far away from the moving average. So, we sold into strength on that stock right there. Autodesk, same thing, coming right in here. You can kind of see, you got to also, if you use this in conjunction with levels of support resistance, you can see here, active sequence, but we're still kind of fighting this important area of resistance in here. So it kind of was battling it, came back down to value, the 50, and then started an active sequence right out 300, got about 10% trade on this just in over a couple of weeks. Nice active sequence and a nice trade on Autodesk. Zscaler, same thing. We use this. You can kind of see gapped up, pro gap up, came back down because it was away from the moving averages. You kind of gapped up into some resistance here. But then again, you find value, you start breaking through, nice active sequence, sell into strength, buy into weakness, sell into strength, buy into weakness, sell into strength, buy into weakness, sell into strength. That's how we use this as a trader, and that's how you too can use it as well. Show you some different stocks. Sherwin-Williams, same thing. Nice sideways consolidation. Okay, finally breaks through, gets in an active sequence, gets away from value, pulls back in, gets away from value, pulls back in, all the way up, and you can kind of see this. And then you see that, again, if you're using this in conjunction with a topping kind of candle here and then a flat top, you get out on this breakdown. Then again, Sherwin-Williams just at the around middle of July got into another active sequence, and you could have got another 20 points just out of that little candle there. So you can see how we're using the moving averages just on the daily chart. And again, it's just giving you an idea on how to trade. It's not saying that you can't trade Sherwin-Williams when it's below here. You're trading it differently. You're trading it because the key is being a successful trader. You're looking to get an edge. And, this is a good way looking at the charts to get an edge. Now, we also use moving averages on different time frames. We love to do our setups and our entries and exits on the hourly chart. I love using the hourly chart, okay? And the moving averages I like to use on the hourly chart is I like to use the 200, okay? Simple moving average, and I like to use the 20. Okay. And again, longer term, simple, shorter term, more of a exponential moving average. And what I like about this, I just want to show you how we use this on the hourly chart. So you can kind of see here, this is Roblox. We just did a trade here the other day. If you watch our show in the afternoon, you got to see this trade, got it called out, saw exactly what the result was the next day. It was a good trade. And this is what we are looking at on the hourly. First off, you can kind of see in here, the 200 really was a lid for this stock on the hourly chart. Now, you finally got a little breakout. And what we love is breakouts that break out, come back, test it as support, which we had in here. And then it kind of came back. And we were talking about this. Sometimes you get this little pullback, and if it holds an important level, you get an explosion out, which is exactly what we did. So we bought Roblox on a break of the 200 right here. It went up really nicely, 10% trade just in one day, and it was a nice little trader just using the hourly chart. Okay, another example to the flip side is Twitter. Right, a lot of people I see we're basically looking at Twitter and looking to trade Twitter, right up in here. And if you go to the daily chart, you can kind of see, we're talking about like right in here. It looked like it was flagging and getting ready to break. And I warned our traders. I was like, wait a minute, right in here, it doesn't look like it's going to break because the 200 on the hourly chart is becoming a lid, and it certainly did become a lid. And then what do we see this week? Twitter kind of fall off from really breaking down on that trade. So, really good using these moving averages can really give you an edge in your trading. And again, we talk about, if you're looking at the 1 minute chart, a little bit different scenario here. Typically, we're using the 22 exponential, and we're also using VWAP. VWAP is, basically a volume weighted average. So it's specifically used by professional trade desks to really, define whether or not they've gotten a good price when they're entering and exiting positions, based off of the trade desk and how they're doing it. Because typically institutions, because they could move markets, are averaging into their positions. They're not getting in all at once. So, I hope this video helped you, because I know we get a lot of questions during our show. People asking how we set up our charts, what we're looking at. And, really, if you notice, I kind of cleaned up my chart, took off all my levels on SPY, and, just left the moving averages. And you can see, just using the moving averages, you could really use that to set up your markets and your value zones without even looking at supply and resistance, just using moving averages. All right, guys, good talking to you. Safe trading, and I'll talk to you soon.